Well, hi there, Dave. How are you today?
Hi, David. We're doing fine. We're doing a little bit more outreach for the Crossroads podcast. I think we're going to probably get more viewers, and I'm looking forward
Hope
to
so.
that. Today, I just posted to my 22,000 LinkedIn followers the last episode that I thought was so very good.
God, you beat me by two. I only have 21,998 because I copied your list and I took you and my name off. So I mean, but this is TCA Crossroads where entrepreneurs and investors connect, and hopefully we'll come up with some really good learnings. And I'm real excited today because I think we're going to get to a foundational issue that faces many of the entrepreneurs, and that's relating to compensation. So
Right.
I understand you have a phenomenal presentation based upon your, few years of experience in this.
Do just that. Let me start by telling you that, and I've never told anybody here, that I am a 10% founder and executive chairman of a company called the Smart Money Group, located in Ohio, that serves all 14 of the heartland states with data acquisition, special events, and reports. And what you're about to see is not from that group. But because I have such deep experience in this, I was drawn to what you're about to see from a company called Pilot, an HR company. And they have done this now for 5 years. I
Mhm.
ran their report through Claude, added a little bit of my own data, and I think you're going to like this. It certainly is eye opening, if nothing else.
I think the timing couldn't be more perfect. I mean, I've been getting calls from some of my clients on what do I do in compensation? Should I take
Right.
more? Should I take less? What if I were to take more and that would speed up the growth? Or I'm trying to understand that logic. I mean, you should be able to speed up growth regardless.
You hit that just right. Go ahead.
Yeah. So let me bring on the slides. We'll go from there.
This is the Pilot fifth annual Startup Founder Salary Report. Look on the right hand green. Average salaries are down 43% for founders from year to year, 2024 to 2025. And this is based on 1,844 founder responses. Wow, we need to talk about that. So, why? The answer is most of the founders are understanding that it's harder to raise capital, and bootstrapping is turning out to be self funding 77% of the time, year on year. Whoa. And it is now all about runway over salary. You might guess that. But it really is because capital is tighter now than it was a few years ago. And that's the bottom line. So capital efficiency is the new founder mandate. And we're going to talk about why and what has happened as a result. So let's just do the key findings so that we can then delve into it. First of all, the median founder salary. Remember the median, exactly the middle, as opposed to the mean, which I always have to remind you is the sum of the 1,844 divided by 1,844. What we're going to find is because AI is 40% of the time, AI salaries are higher than all other kinds of salaries during this last year. And so the mean is higher than the median. But therefore, now I've said that, the median, the exact middle, is $75,000. You'll find it to be lower when we get to startups. Thing is that 60% of the startup founders are paying under or being paid under $100,000 because they're putting their money into the company rather than taking it for themselves. 5.4% of them take no salary at all. So for those of you founders who are watching or listening, that's not so bad. It tells us that you have so much invested in your company that you're not willing to ruin it by taking more money for yourself early on. And 18% of the companies, and remember it's 1,844 companies, are bootstrapped instead of getting any kind of funding at all. So what's behind the report? We've already said it's the fifth edition, 1844. 40% of the response are AI companies. Now that'll tell you a lot because as we see a number in just a few moments, you'll understand that. So remember mean versus median? Median is the exact center. It fell 43% in 1 year. So if we look at the median, that is the center, is 75,000. If we add AI salaries, it'll be 98,000. Now, there are various funding stages. We'll get to that next. So there are three kinds of salary funding sources. VC backed in the upper area that we'll talk about when we see what upper area means. That's 100,000 or more. The typical VC backed salary is 75,000, and the typical bootstrap salary is 60,000. So believe in equity. Relative founder salary by team size might be important for those of you who are watching, because then you can now get down to whether or not you should be in one class or another. It turns out that the threshold where salary founder pay turns into sustainable and larger numbers is about 11 to 25, which means above 11 to 25 employees, the startup founders aren't taking any more salary significantly than they were at 11 to 25. So if you have 50 employees, your salary is about the same as 11. But if it's 1 through 5, which is where you and I often play in these fragile early startups, David, it's about $55,000. So for you small companies, don't feel bad about taking a smaller salary or none at all. And I'll stop there just for a comment, David, to see if you have anything for this before we go on.
Yeah, I mean, first of all, it's eye-opening, and thankfully the salaries have come back down to more of the reality of what I had expected. I've seen so many startups where the salary has just increased to 115, 120, and they build up the executive team, and it's all salary focused versus going into growth. There are two things that I want to point out. Number one, and it goes to your average versus median. When we look at medtech deals, the medtech and medical deals, because of the salaries of the medical doctors, who are either investors, but many times they're not, those salaries are higher. So so you're pushed for the median and the mean to a higher number if you just segment it in terms of tech versus medical. So I wanted to point that out. Don't necessarily agree it's the right thing, but also it's clear that there's a correlation with this chart, relative founder salary by team size, that as you grow your team, you're moving from pre-seed to growth, and then super growth. And therefore, as your team increases, your salary will naturally increase. So the question to you is, have you been able to break this down by pre-revenue, seed stage where you start getting the MVP introduction, and going beyond that into growth?
Well, you know that Pilot has done that. And a moment ago, I told you that I am in the business of doing that. So you're certainly going to see it next.
Perfect.
So what the market looks like across the funding stages. A seed company is one that looks like it has raised 100 to 150,000. And if we look at that, now this is not bootstrapped, and this is not 1 through 5. They've already made a raise, which means they've gotten through that first very difficult area. It looks now like the mean is 150,000, and I have a hard time with that, but they've already found their raise, and so they pay themselves more. If we look over on the right-hand side, Series A, the salaries are higher, Series B higher than that. And then Series C plus, we've gotten into real companies. So pre-seed is where we often play. So don't let this take you too far. How do the founders actually set their salary? This is really kind of interesting. 75% or more give pay for founders who benchmark against the market rates versus those who simply take what the startup can afford. So 31% of those our startup can't afford. That is what the people pay themselves. I know I did way back when I had my first startup. And in my second startup, it was much more successful and I took more, but you get the idea. Then some, and there are 3 more, take a loose read of the market rate. Some draw only as are needed. And then some get investor guidance or board guidance. But the thing to take away from this is 31%, what the startup can afford. So I've added a couple of charts here, again from Pilot. So how did they determine their salary, those startup founders? Well, 19% were based on personal targets. 22% said the fair market rate. They went against any of those surveys that you can buy or find. 20% said, I only pull money when I need it. 31% It's what the startup can afford. You saw that number a while ago. 7% other and 2% use the pilot founder's salary report. Well, heck, that's not fair. That's their own report. So AI startups, which I kind of alluded to a minute ago, buck the downward trend because AI is everything. And so I had to add another slide, and you'll see it in a moment, that talks about what is AI. So AI salaries, the median, that is exact center, is $90,000 and is up 20% over non-AI founder pay. So there is a premium for AI companies. But what's an AI company? Coming next. 40% of the respondents run AI startups. So that's why the mean is higher than the median, because 40% of those respondents run what they call AI companies. Wait a minute. What's an AI company? Well, if the average AI salary against all different sizes is 111,000, and we look at big data companies, the second line back down, 154,000. But wait a minute, go all the way down here. Software I can understand. AI and consumer goods, 122,000. Industrials, 118,000. Go all the way down to what they call themselves as AI in telecom and AI in real estate and AI in marketing. I can't go along with that, David, because I believe that these are companies that are now calling themselves AI, but aren't necessarily built upon AI. Your thoughts?
Yeah, I totally agree with you. I have a hunch, it's like reminds me of the 2000, 2001 era when everyone was calling themselves .com and seeing
Right.
an increase in the valuation. There's AI, there's algorithms, and there's a confluence of what AI really is. And I totally buy into the big data software, area as well as consumer goods, because we see the AI being used to help make better decisions. I mean, the perfect example would be, the Amazon or some of the clothing companies that are using AIs, or the eye companies, the glasses companies. So I tend to believe that AI is really in the upper level of this chart, and the other ones are there. They're called AI, but they really aren't. But what's also interesting, and I think, that maybe it's a different discussion, because you're trying to find the right people in your AI type startup, they're also competing with the Googles, the hyperscalers of the world, the other companies that are in this business of using AI to grow. So now you have to make a decision whether or not you go to a startup and I get my salary plus equity where the real kick is,
Right.
or do I take the safer approach and get less equity, but I get a bigger salary? So you're really seeing the salaries increase because it's a supply and demand in my mind. I don't know if you feel the same way, but that's the way I'm looking at it.
I think people who are in big data know that their salaries are higher because there's an area that is needed so greatly right now. Let me just ask a question you don't have to answer. If you were Netflix as a startup, are you an AI company because you're working on how to bring more people and get more people to view particular movies because you're giving them recommendations? Or are you an entertainment company because you amalgamated entertainment from other sources? Forget before.
That's an easy answer for me, actually, because I start with the end in mind.
Right.
Netflix is set up as an entertainment company, and I use AI to help build that entertainment experience, versus I'm developing AI like OpenAI or Anthropic or Grok or Gemini,
Exactly.
which are literally AI companies that provide the picks and shovels to these other companies.
It is the picks and shovels that I was trying to get at. Those are the
Correct.
people that really need and get, because there is so much competition for that talent, the higher salaries.
Yeah.
All right, so I took another slide that wasn't in this summary, and I took the average and the median again over the years. And I wanted you to see that 37% of the people in 2024 paid themselves less than $100,000. But if we look at 2025, 60%, up from 37%, paid themselves less than $100,000. And that's a big number. And it says what I've been trying to get you to say, or at least drive into your minds, that people now are thinking capital efficiency is much more important than how much they draw from a company.
Yeah.
And then if there were companies that took no funding, the number has gone up in 1 year from 10.3% to 18.2%. That's a 77% increase just in that one thing. Companies where the founder took no salary at all. All right, so how about the salary by run rate? This is now revenue run rate, not the amount that they raised. So if the revenue is under $100,000 per year, the average salary is about $45,000, and the median is $62,000. But let's go to the average. I think that's a better number. And if it's 100,000 to a million, it's 75,000. And you can begin to read some of the others on this. But doesn't that make more sense now that we're talking about early stage startups? The numbers are even smaller because these are revenue run rate companies that are just beginning to accelerate. Let's look at where the salaries are the highest. I didn't have to tell you this, but I had Claude give me this summary because I thought it was really important. Go to the bottom one first. 103,000 is the average salary in the San Francisco Bay Area. But if we go to the outside major hubs at the top, is 65,000. Remember, I'm helping to manage a company that deals with big data in the heartland, which are the 14 states that we fly over. Salaries are lower, expectations are lower, and that 65,000 number is considered a pretty good number. Then again, the cost of living in San Francisco Bay is higher. Then again, the talent itself is harder to get because there's much more competition for it. A playbook for us right now, and we're down almost to the end here. Here are the 6 things that I would think a capital efficient company ought to do. Match the pay to the runway. If you've only got 6 months worth of runway, cut your pay because it's very hard to raise money. We know that. Number 2 is benchmark deliberately. Don't just go find the highest salary that is in the area that you're in and expect to be paid that. Benchmark deliberately. Number 3 is stage your raises. Keep your pay lean below 10 employees, and then begin to let it go up as more employees and maybe even the raises have become more logical. Number 4 is lean on equity. If self-funding, then be very careful. But if you have gotten the point where you have more equity, you can be more relaxed. Number 5, revisit it annually because things change a lot, as you might guess, as you saw by the great reduction in rates this year, made, I think, by fear of not being able to raise the money that was easier to raise in previous years. And finally, number 6, communicate the why. Frame your comp choices to your board as evidence of your financial discipline. Why not? Makes the board happier, makes you look better, and it really is more accurate as well. So I said a minute ago, capital efficiency is the new founder compensation reality. The pay reset is down 43%. The stage and source have to decide where you are. And benchmarking is really important. And I'm giving you some of these benchmarks now from Pilot, but they are benchmarks that we ought to use, especially as we look at how we fund startups and whether the startups are being drained by high salaries when maybe they shouldn't be. And that, David, is the last slide to give you an idea of how salaries should be benchmarked and how salaries should be calculated and how capital efficiency is the reality today.
Totally agree. I think I'm almost speechless, but not really. But seriously, I think you hit the nail on the head relating to capital efficiency, the way you should, present salary. Because when we look at things, as you know, as an angel or an investor, you want to make sure that people are not just blowing money on self-serving interests. And unfortunately, we think salary is self-serving. But let me ask you one final question, and
Sure.
this will close it off. I'll give you a choice. If you had to choose between a founder who takes too little salary and risks burnout because the wife is saying, I don't have enough money or whatever, or one who takes too much salary, but because they take that salary, they work doubly hard and they shorten the runway, which is the biggest risk to the company?
You're doing it by risk. And so I would say risk toward funding rather than risk to the company. The
No,
biggest
risk
risk is
of
too
growth for
much.
the company. Yeah, risk to well, yeah, either funding or risk of growth. We'll break it into two parts.
All right. So risk of funding, too high a salary, we will stay away from it. We think
Right.
that the founder is taking our money and using it poorly when we know that that money should be used 100% for development and then market penetration. So if it's risk toward burnout, which is what you asked a minute ago, and that's an interesting one, I think either of them work. Meaning to say, you're going to
Yeah.
be working just as hard with no salary as you are with a high salary, maybe even much harder. In which case, I would lean toward low salary. We will fund it, and we think that the entrepreneur is invested. And I think that's an easy answer for me. You?
I totally agree with you, by the way. I was just trying to see if you and I, after all these years of working together, we come up with the same answer, and I think we do. But yeah, I thought, first of all, I think this was a great presentation. I think there's a lot of learnings for the entrepreneurs, also the investor side, to make sure you just don't throw money into CEOs and the executive team willy-nilly. It really becomes an issue of capital efficiency relating to funding, relating to growth and stage of the company. But I'll let you have the last word, and then we'll close it off for this episode.
The last word is capital efficiency, capital efficiency, capital efficiency, because it's going to be harder to raise money. And thanks to Claude for making these slides very easy for us to read out of a very much longer, convoluted presentation by Pilot. Thanks, everybody. Thanks, David.
And for David Berkus and David Friedman, myself, we thank you for listening to TCA Crossroads, where investors and entrepreneurs connect. See you next time.